What if I told you that this chart could help you predict this one? The price of crude oil is a major factor for your paint, airline and tire stocks. The price of copper can help you understand the wires and cables industry. The price of gold can impact your gold finance stocks. This is the world of commodities. And for a trader, it's one of the most powerful tools that you're probably not using. So in this video, we're going to break down what commodities are, why they move, and how you can use them to get an edge in the market. Let's get straight into it. First, what is a commodity? It's simple. When you buy a stock like TCS, you're buying ownership in a unique company. No one else is TCS. But when you buy a commodity, you're buying a standardized good. Gold is gold, whether it's in India or Africa. This standardization or fungibility is what makes it possible to trade on a global exchange. And this isn't some new age asset, it's the foundation of all finance. We're talking about an asset class that goes from ancient barter to the first ever organized futures market in the 17th century Japan, and to our very own Bombay Cotton Trade Association founded right here in 1875. But why do these markets even exist? At their core, they serve one primary function: to transfer risk. In any commodity market, there are two players, hedgers and speculators. Let's understand with an example. Let's take a farmer, a hedger. He is worried that the price of cotton will crash by harvest time. So he uses the futures market to sell his crop today at a locked-in price. He is transferring his risk. So who takes that risk? The speculator, that's the trader. They want to take on that risk. Their research might suggest a drought is coming and prices will rise, so they buy the contract that the farmer is selling. The hedger gets certainty and the speculator gets opportunity. Both are essential. When you trade commodities, you are almost always acting as a speculator. You're not going to take delivery of hundreds of barrels of crude oil. You are just trading the price direction. So what can you actually trade? There are four main pillars, and as a trader, here's how you should think about them. First, precious metals like gold and silver. This is the fear and inflation trade. When markets get volatile or inflation spikes, money flows there. Second, energy like crude oil and natural gas. This is a geopolitics and policy trade. One war, one OPEC meeting, and these charts will move. Third, base metals like copper and aluminium. This is a global growth trade. It tells you how healthy the global economy is. If it's rising, factories are buying and the economy is building. Fourth, agro products like cotton and palm oil. This is a weather trade. One bad monsoon, one drought report, and that creates a trading opportunity. So let's put it all together. Understanding commodities can give you an edge in your stock analysis. They are standardized goods, not unique companies. The market exists to transfer risk from the hedgers to the speculators. And each type, metals, energy, agro, gives you a different signal on the global market. So in this video, we've covered the what and the why. In the next episode, we'll get into the how. We'll break down the exact futures and options contracts you can trade. We'll cover lot sizes, expiry, margin, and how you can build a trading setup. So make sure to subscribe and hit the bell icon.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.